For most traders, the game is over when the markets close, right? But what if I told you that your biggest blind spot, the thing that can quietly chew up your hard-earned profits, has absolutely nothing to do with your charts or your strategy? Okay, let's get into this, because today we're talking about how to turn taxes from a painful afterthought into a key part of your trading edge.
Just let that sink in for a second. You've had a fantastic year. You managed your risk, you stuck to your plan, and the P&L looks amazing. But what if there's this hidden trade, when you didn't even realize you were in, that could wipe out a massive chunk of those gains?
It's really the one thing that's certain in trading, but so many people fail to plan for it. You know, an unexpected tax bill isn't just another expense. It's proof that your trading plan was incomplete from the get-go. And honestly, it can feel like a really devastating loss, long after you've closed out all your positions.
And this, right here, shows you the stark reality. Over on the left, that's the number that gets all the glory, the gross profit. But on the right, that's the number that actually matters. It's what you get to keep. That gap between the two can be seriously shocking. And our whole goal today is to give you the tools to help manage and hopefully shrink that gap.
So, where do we even start? Well, it all kicks off with a simple but super important question. How does the IRS see you? Because whether they label you an investor or a trader changes the entire rule book you have to play by.
What's so interesting here is how your own activity defines your status. An investor, they're kind of like the tortoise, playing the long game, holding for capital gains. But a trader, you're the hare. You're in and out, aiming for those short-term profits. Now, if you qualify as a trader, you can unlock this really powerful tool called mark-to-market accounting. It basically lets you treat your gains and losses as ordinary income, which can simplify things a lot. But more importantly, it lets you deduct all of your trading losses without the usual limits. That is a huge, huge advantage. So the takeaway here is your trading style itself is the very first move in your tax strategy.
Okay, so you've figured out your status. Now it's time to learn the rules of the game. And just so we're clear, these aren't suggestions. They're the non-negotiable laws that are going to govern your profits and your losses.
This is one of the most fundamental things you have to get right in trading taxes. If you hold an asset for 1 year or less, that profit is a short-term gain. It's typically taxed at your higher ordinary income rate. But if you hold it for just 1 day longer than a year, it magically becomes a long-term gain, which gets a much lower preferential tax rate. For anyone who's a swing trader or holds positions for a while, understanding this difference is absolutely critical to maximizing what you actually take home.
All right, now for a rule that trips up so many active traders, the wash-sale rule. Put simply, the IRS doesn't want you selling a stock just to get a quick tax loss only to buy it right back because you still think it's a good investment. This rule is designed to stop that exact move.
Let's walk through this because it is so important. So you sell a stock, you realize a $1,000 loss, and you're thinking, great, that can offset a gain I have over here. But then, maybe 2 weeks later, you buy that same stock back. Well, because you did that inside the 30-day window, the IRS basically says, nope, that loss is disallowed for now. Now, it's not gone forever. It gets tacked onto the cost basis of your new shares. But you can't use it to lower your taxes this year, which can be a really nasty surprise come tax time. Okay, enough about the rules that can bite you. Let's talk about the strategies you can actually use to your advantage. It's time to stop playing defense and start playing offense with a proactive tax plan.
And probably the biggest tool in that toolkit is something called tax loss harvesting. This isn't about being happy you have losing trades. Nobody is. It's about being smart with them. It's a strategy of intentionally selling some losers to cancel out the taxes you'd otherwise owe on your winners. It is one of the most powerful things you can do to improve your after-tax returns.
And this simple table just shows you how powerful it is. Before you do any harvesting, you've got this big taxable gain. But by strategically selling some of those positions that are in the red, you generate a loss that directly wipes out some of that gain, shrinking your final tax bill. So the point is, a loss doesn't have to be just a loss. It can actually be a tool to help you protect your wins.
But here's the catch. Just when you're getting all excited about this awesome strategy, you have to remember that rule we just talked about. If you're not careful, your brilliant tax loss harvesting plan can be completely wiped out by an accidental wash sale. They're really two sides of the same coin, and you have to know how to manage both of them.
So how do you manage all this stuff? With data. Your best defense and your best offense is keeping meticulous records. And I'm talking every little detail. Your entry and exit dates and prices, of course, but also all the commissions and fees, any margin interest you paid, your software subscriptions, even home office expenses if you actually qualify as a trader. If you ever face an audit, these records aren't just helpful, they're everything.
We've covered a lot of ground, from your tax status to specific rules and some smart strategies. But honestly, we've just been scratching the surface, which brings us to our final and maybe our most important point of all.
Trying to navigate the tax code can feel like you're lost in a maze. I mean, do you trade futures? Then you have to know about this 60-40 rule, which gives those contracts special tax treatment. Remember that mark-to-market election we talked about? There are strict deadlines and very specific procedures for that. And that's not even getting into the minefields of reporting international accounts or figuring out crypto taxes. The point is, the tax code is incredibly complicated, and it's always changing. Trying to go it alone is one of the riskiest trades you could possibly make.
You know, this quote from our source material just says it all perfectly. The best trade you can make isn't on the charts, it's getting a qualified professional on your team. They don't just help you file your taxes at the end of the year. No, they help you build a strategy from day one to prevent those costly mistakes and to maximize what you actually get to keep.
So I'll leave you with this one question. A plan for your entries, your exits, and your risk management, that's all essential, of course. But if that plan doesn't include a plan for taxes, is it really complete? It's time to stop treating taxes like a surprise and start mastering them as part of your core strategy.